Hello everyone, welcome to our discussion of chapter 1. We're going to jump in here with the question, what does it cost? That's what we're going to spend a lot of time over the next 3 chapters talking about ways that we go through the process of calculating the cost of an item. And we're going to learn basically 2 very specific ways, and then a third way that kind of relates to the other 2. And really, every business, every manufacturing, whether it's making something, is asking themselves the same question. What is this costing us to make? Or what would it cost if we did this in the future? Okay, so maybe we're not doing that now, but we want to do it in the future. Maybe someone has come to us and asked us, can you do this project for me? And you say, sure. And they say, well, what am I going to have to pay you for it? And so you need to know what it's going to cost you. You need to estimate what it's going to cost so that you can make a profit. You can charge them enough to cover your costs and make a profit. So every business is facing this issue. And remember from our discussion in Accounting 160, we talked about various cost definitions. We talked about direct costs versus indirect costs. We talked about raw materials, direct materials. We talked about overhead. We talked about work in process. All of those pieces. And remember that we learned that when we get our materials, we put them in raw materials. Then when we utilize them, we put them in work in process. And then when we're finished working on our product, it goes to finished goods. And then when we sell it, it goes to cost of goods sold. That process hasn't changed, and that's not going to change under either one, any of the things we're going to learn. We're going to refine how we deal with each of those steps, each of those pieces, each of those kinds of inventory to make it as accurate an estimate as possible as to what it costs us to do these things that we are manufacturing or projects that we're undertaking. So we're going to start with job costing, all right? And when do we use this? When are you going to see this? Or why do we use job costing? It's for developing the cost for projects that are customized, meaning different for each customer. So if a customer comes to you and says, I want my house built in a particular way, that's a customized house. You want to have these rooms and this square footage and all that stuff. And you can easily separate that house from any other houses you're building for some other customer. So it's easy to say, I mean, it's not the same. And so a lot of the costs are going to be separate and different for one of the jobs versus the other. So that's what we're looking at with job costing, is the types of projects, the types of work, even the types of manufacturing where a particular product is made to order specifically for a customer and has a very distinct beginning and end. You know when you're going to start and you know when you're going to end. Okay? So building submarines, cruise ships, those are big projects. Maybe smaller installation of computer system, computer networks, architectural drawings would be a job. Okay, these are all the types of things we would use job costing for. And so, why do we want to do this? We're going to track the cost by job. We're going to literally record which job the materials, the labor goes to, and therefore we should be able to understand how to estimate our cost in the future jobs. So it's not just to know how much that job we're working on right now costs. but it also is a good idea to know what it costs to do something similar when another customer comes to us and says, how much is it going to cost me to build? Okay, so we're going to have better estimates. And then when we're done with a job, we're going to compare what we thought it was going to cost based on our estimate to what it actually costs. But if we don't tracking by job, we don't have that ability. All we do is finish the job, charge the customer, and we don't know if we actually came in the way that we were supposed to. And so those are all of the reasons why we use job costing. All right. We'll learn about process costing, which is where there isn't a customized product. All the products are the same, and they're made in batches or in continuous production. Yeah, we'll do that in chapter 3. Okay. So this is what we're starting with, is job costing. So remember, we need to work with direct materials, direct labor, overhead, right? And so in any system or any way of doing costs, needs to consider those 3 pieces. Okay, so direct materials could be purchased and bought in bulk. Okay, and at the time you buy those materials, lumber, metal, whatever, you don't know what job they're going to be used in. So you put them in a central warehouse or some storage facility. Okay. And you increase or debit raw materials inventory, and you increase accounts payable because you're probably going to pay for them later, or credit accounts payable. Okay, so you got stacks of all of this materials in your warehouse or in some type of a facility of some sort, showing what you've purchased. That's very similar. That would be the case with the job costs. It's the same case with any type of inventory tracking system. Then when the materials are taken out of that general storage area and used on a particular project, if you're building houses, that lumber is taken out of our central warehouse and taken out to the actual job site, that transfer will need to be recorded. We're going to reduce or credit our raw materials inventory or warehouse inventory, if you will, and we're going to debit work in process inventory for that particular project. We're going to indicate in our accounting that we use it on project A or B or C or 100 or whatever, however you identify your individual projects. Okay, you're not going to just throw out that lumber to wherever. You're going to take it to a particular project. Okay, and so what we typically do is set up an account, a work in process account or work in progress. Remember, those terms are used interchangeably for each job, each project. So you'll have, because you have a start and a stop, you know when that job starts, you know when that job is going to be finished, or when, or at least you may not know ahead of time exactly the date, but you know how to tell it's done. The house is complete, the submarine is finished, the architectural drawings are accepted by the client. Okay, that's what we mean by we know it's done. Okay. So direct materials are those things that can be easily traced to the job. If you have that stuff put in that house and you utilize it to the plumbing or the lumber or the concrete or whatever, that's a direct material that could easily be traced to the job. We put it in there, we installed it, whatever, and we document that. Okay, hopefully every time those raw materials go from the central warehouse to the job site, that we have indicated that it may be called a purchase requisition, a materials requisition. There may be, but today is probably an electronic request, a text even, okay, that is saying, bring me this stuff from the warehouse, okay, to put into the job. Now, some raw materials may be purchased, and we know it's specific, it's so unique that it actually doesn't go to the warehouse, it goes directly to the job site because it was something that was unique to that particular job. And so maybe you can skip a step. Okay, you could debit directly to work in process, or increase the work in process and credit accounts payable when you order or buy that stuff. All right. So, but we'll generally assume that it goes to a raw materials account and then, or central warehouse account, and then when it gets used, it comes out of that and goes into work in process. Direct labor. Okay, so we've talked about direct materials. Now we talk about direct labor. Okay, it's a little different because there's usually not a place you can store direct labor. You can't store up hours. Okay, so each person who is working on a job, okay, is tracking their time card. Okay, in their time card, what they work on, what projects they work on, so that when we pay them and debit the work in process account. So if they work 4 hours on job A and 4 hours on job B, when we pay them, we debit work in process job A, debit work in process job B for their 4 hours. We credit payroll payable or salaries payable to indicate that we owe that employee that money, and then eventually we debit that payable and credit cash. Okay, this is all very automated today. Okay, literally you're swiping cards when you move from one area, working from one job to the next. When you're working on something on the computer, it's keeping track of the minutes you're in a project so that you can transfer that to the job sheet, and so that can indicate how much you should be paid as well as how much time was spent on that job. Okay, so you only know if they do a good job of swiping in or writing down what they're working on, all those kinds of things. Okay, so we increase the work in process for that particular job, right? Because it's indicated at increased wages payable, or salaries payable, or some kind of, or even cash if we're paying them directly. Okay. Manufacturing overhead, the harder part, the part that's going to give us the most challenge, because remember, direct costs, if you can get people to and everybody to write down or somehow barcode or whatever it takes to indicate what direct materials and direct labor is being used, that's not hard to track. What becomes a little more of a challenge is manufacturing overhead, because by definition, manufacturing overhead is indirect. Okay, this under job costing, that is any cost that cannot be directly assigned to the job. So if it wasn't done directly on that job or wasn't used directly on that job, it is indirect. And we accumulate that cost. It's not like it goes away or we can ignore it. Okay, it has to go into an account called manufacturing overhead, factory overhead, whatever term you want to use. So give an example of how this kind of plays out. You've got an engineer's time card. They work 3 hours on project B. So they put that down on their time card electronically. 4 hours on project L, and 1 hour for a safety meeting that everybody has to go to, but doesn't have any relationship to any specific job. Okay? So his pay for the 3 hours goes into work in process for project B. Same thing happens for project L, but for 4 hours. And the 1 hour would be go into manufacturing overhead. That's indirect labor. It is not specifically assigned to the job. Okay? So that goes in manufacturing overhead. Indirect materials, another example, may come out of that same storage or warehouse that we brought our direct materials out of, but didn't go to a particular job, went to the vicinity of multiple jobs and got utilized. Okay, things like nails or other small items that we're not going to track and keep track of how many nails we used on a particular situation. Okay. So that goes into, also increases manufacturing overhead. So that would credit the raw materials coming out of the warehouse and debit the manufacturing overhead account. There would be utilities. There will be supervision costs, the cost of the supervisors, of the foreman, that sort of thing. People that come and clean up after those who actually do the direct labor, the maintenance, the people who fix the machines when they break down. All of those, okay, are going to go into the manufacturing overhead. Anything indirect, but that is still necessary to make the products, okay, but cannot be identified as going to one particular job, okay, then they go into overhead. So you're just getting this big pile of overhead, right? This account is getting filled up with stuff that we're spending. So how do we take that and use it to answer the question, how much is it costing for this job? Okay, so we talked about the increases. That's the debits to the manufacturing overhead account. What about, how do we take that and assign it to jobs? Well, first of all, we have to do something that involves an estimate. We have to estimate the whole year before it even happens, okay, how much overhead we're going to have for the whole year. Because here's the problem, the overhead, because it's not specifically related to jobs, doesn't happen evenly over the year, doesn't happen in relationship to the jobs. So you may have 3 jobs going on in the winter time, okay, and have utilities high because it's cold, and have 5 jobs in the summertime and have the utilities low, okay, because, or let's say the springtime when it's not really cold or hot, and when it's pleasant, you don't have that high utilities. So those utilities aren't based on the number of jobs or the work you're doing, it's just based on the temperature outside. So you have to estimate that at the beginning of the year and kind of spread it out like it's even over the whole year. And so we estimate the overhead for the year, we estimate an activity rate, and we get a cost per unit of activity. That's a predetermined overhead rate. And I can't emphasize enough the idea of pre. This is before you do your manufacturing for the year. So you look forward, you do an estimate to do your predetermined overhead rate. And that's the rate you're going to use to apply to the job. So perhaps the hardest thing about this is choosing an activity rate. What is it that you're going to use to take this big pile of overhead and allocate it to individual jobs so that you know or can estimate how much that job costs? Because if all you know is the direct materials and the direct labor of a job, you're not done. You have to have an estimate of the overhead, and it is an estimate. So first of all, you need an activity that is easily counted, something you're already tracking. Machine hours, equipment hours, direct labor hours, direct material purchases, something like that. Not something that you're going to have to pay somebody to sit there and count. Okay? And then the next thing you want to think about is, does this activity, does the fact that we do more of it generate more overhead? Now, that's a hard question to answer, because if it was really easy to answer, it would be a direct cost. It would be a direct material, direct labor. But because it's not, it's a little harder. Okay? So, an example. You got 2 houses being built. They're 2 different jobs. Okay? They're 50 feet apart. What activity is easily measured might help estimate how much indirects, okay, might help us estimate how much one of the houses uses in terms of these indirect costs versus the other. Okay? Because let's say they're different floor plans, they're different customers, and so they're different, and so we need to know what is going to be logical in assigning the overhead to these jobs. To take the total overhead and just divide by 2 is pretty lame. Okay, easy, but doesn't do us a very good job of really asking the question, what is it about these 2 jobs that makes them cost more or not? Okay, so one idea is that one house needs more workers, more direct labor hours because it's bigger or whatever. That's easy to track. And with that result, if we have more workers, we need more indirect labor, more maintenance, more supervision, more equipment, more supplies. Okay? So if that house had more workers, would it also use more of these other things? And that seems somewhat reasonable. If not, if it doesn't seem reasonable, if it doesn't make sense that that would be the case, then maybe we need to look at something else. But this could be, direct labor hours is a possibility, okay? But if it doesn't work, and the idea that you'll have a perfect activity rate is not true. You're going to find something that's reasonably good, that makes sense, not one that's perfect by any stretch, okay? Otherwise, you get frozen and you can't make a decision because you're trying to find the perfect answer. So we need to assign that overhead to job. So if the estimated overhead is $450,000, the chosen activity rate is direct labor hours, because we went through that process on the last slide, and we estimate 50,000 hours for the year. So this is for 2022 before we start doing anything in 2022. Okay, we estimate that. Okay, our predetermined overhead rate is 450,000 divided by 50,000. That's $9 per direct labor hour. So the idea is that any project, you have a cost for the direct labor, and then you have an overhead cost that is higher based on how much direct labor hours you use. Okay? And so you're going to say, okay, here's the direct labor hours that they spent, and this is what the cost of those direct labor hours are, and this is the overhead cost that we are estimating based on the fact that they use those direct labor hours. So if a particular project uses 2,000 direct labor hours, okay, this could be because someone came to us and we're doing an estimate or a bid on a job, or this could be something we're actually working on and keeping track of. Okay, then we can see the overhead allocated would be $9 that we had from the beginning of the year, before we started, times 2,000 hours. Now we don't care when those hours are. We don't care if it's in May or June or whatever. You can use that same allocation. Okay, and so if this was something we were working on, we're making journal entries for, we would increase the work in process for that particular job. Remember, we have a work in process for each job. We'd increase that by 18,000 with a debit, and we credit manufacturing overhead by 18,000. So when you're working on jobs, you're crediting overhead and debiting work in process. Okay, so that by the time you finish the job, you have allocated all of the overhead that should go to that job by looking at all the direct labor hours. Now, you could do this multiple times. For instance, if in May you had 1,000 direct labor hours and you assigned $9,000 in May, and then in June there was another 1,000 hours of direct labor and do another 9,000. You can do it in pieces, or you can do it kind of at the end of the job when you know all the direct labor hours that are done. Okay? So remember, every job will have 3 costs added to its work in process. You're never done with a job, okay, until the direct materials have been added and you've identified the direct materials that were used on that job, as the direct labor based on the hours were spent on the job, okay, and we've calculated that cost, and we have used the predetermined overhead rate to assign the overhead, okay. Just remember, the allocated direct labor hours amount of the manufacturing overhead does not replace the amount paid to employees. You don't not pay them. The employees still get paid, but there's those extra costs that go along with having more employees that we're counting with the overhead. Okay? When the job is finished, because every job is unique and we know exactly what it needs to do to be done. The house is supposed to be looked this way. Okay, project is supposed to be completed in this way. Add up those 3 costs, and that amount will be moved to finished goods. And the work in process for that job would actually be 0, right? Because all the direct materials, all the direct labor, all the overhead that's been assigned to that job moves to finished goods. And that particular job is now 0 as work in process. And then you may have other jobs, obviously, that you're working on that are still in process, and they would have amounts in those work in process accounts, but not the one for this job. So when a job is sold, okay, then the amount for that particular job, and we should know what that job is sold because it's going to have a specific customer. We probably put the name on of the customer on the job from the very beginning. Okay, they shouldn't stay in finished goods very long because that was the customer's expecting it. And as soon as they were done, they buy it, pay us, send us some money, whatever. We send them an invoice, and we move that from finished goods, the whole thing, all the direct material, direct labor, the whole total, all the overhead, into cost of goods sold. Okay, so it's going to decrease finished goods inventory and go debit cost of goods sold. Some companies, because the finished goods is not usually a thing with job costing, you can just take the total cost from the work in process right to cost of goods sold because you know it's sold. In fact, you sold typically when I did this with a construction company. The house was sold before we started building, right? We had a name because it was customized to that particular customer, and so when it was time to when we were finished, it was just a matter of going in and signing all the paperwork, and it went right to cost of goods sold. Okay. Don't forget to record the sales price for what you actually charge the customer, and that increase to accounts receivable or cash. Now, let's go back to the idea of that overhead account, okay? Remember that overhead account has debits where we actual overhead costs, the utilities, the indirect labor, indirect materials, all that stuff goes, okay? We knew what those were. There might be some estimates there, but they're mostly things that we paid and had to take care of. We know the amounts, okay? And when the jobs worked on and completed, we're moving money out of that overhead account. We're crediting that overhead account. And they were all estimates, okay? Every time we allocate overhead, it's an estimate, okay? At the end of the accounting period, so you could do this every quarter, every month if you want. Most companies don't want to do it that often. At least at the end of the year when you do financial statements, you have to look at this overhead account, okay? And because one side, the debits, is actual and one side is credits, that's the estimate, you're never going to get that exactly right. If it turns out exactly right, then somebody fudged the numbers, okay? So there's going to be either more increases than decreases, which means it's positive, or a debit balance, or there's going to be more decreases than increases, and there's going to be a credit or a negative amount, okay? We call the positive debit balance under applied overhead and the negative or credit balance as over applied overheads, okay? So that's just how we indicate that, okay? Here's the thing. At the end of the year, when you're going to do financial statements, at least that often, more often if you choose, that overhead has to be zero. You cannot have overhead on the financial statements. So it has to be zero. So that's what you do, is you take care of this over or under applied overhead, okay? If it is a credit balance, you debit it. If it's a debit balance, you credit it. And you put the other side of that journal entry into cost of goods sold. Almost every time. Okay? We may look at the fact that we are the over or under applied overhead and adjust our estimates for next year. We might decide that we have more overhead or less overhead. We may have more or less of our activity rate. We may change activity rates or something because we weren't as accurate as we'd like. Okay? We don't expect it to be perfect. We don't expect it to be within a few dollars. We expect it to be within a few $1,000s. Okay? We expect it to be immaterial, but we don't expect it to be right on. Okay? And if it's a lot, then we probably need to rethink how we calculate what our estimates were and why we were so off.